and so it wasn't too bad getting back in the saddle.
Good. That's great. We've been having a ton of conversations lately with groups who are pencils down and are trying to figure out what direction they want to move as it relates to all the tariff uncertainty. And we started compiling just like broad strokes, anecdotes and like little data points from different groups. And we put together a little post I put out on LinkedIn today. And we had a reporter actually reach out to us and ask us kind of what we're seeing. So I think kind of back towards our conversations from before, the biggest curveball that a lot of these developers are going to be tasked with is managing expectations as it relates to project timing, right? I think there's going to be a lot of delays. I think that's going to mess up interest reserves and ultimately cause extensions. And there's going to be a lot of friction with construction lenders is my guess. You know, obviously I think costs are going to increase as well, but at the end of the day, I think if there's enough meat on the bone, you'll be able to cover the cost. But if timelines are extended and you're not unable to stabilize when anticipated and pay off the construction mortgage when you thought you were going to be able to, there's going to be a lot of scrambling from all parties.
So I will say that part of the business plan for my go forward is to buy those properties or those loans.
Really?
Yeah. So I would rather step in and finish a project all cash, or if you're in like the stabilization period and the world's starting to get a little iffy, if it's a main location and a well-built property, why wouldn't I buy the note and do a loan to own?
Yeah. And you'd buy the note directly from the lender, or would you provide a refi of the current construction loan at different terms?
There's multiple ways to handle it.
Yeah.
What if I took the B piece of the construction loan with the intent to allow somebody to work it out and potentially get paid a significantly higher IRR than the construction lender because you're in that second position, but be able to step in case the group isn't able to perform. There's the outright purchase of a construction loan. And at that point, what you're really doing is looking at it as a mark-to-market play, where maybe the sponsor's wiped out, the LP doesn't know what they're doing, and rather than play that game, put more of a professional approach into finishing the project out, whether it's lease up or construction, and just take it out. But really, the ultimate goal is to become beneficial owner of the property because you have faith in either the market, the submarket, you know, the story of the property, the location, the fundamentals. So really what everybody's initial underwriting is becomes worthless. It's really just looking at where we are in the market and what things are going to be trading for.
Yeah, no, I think it's a brilliant strategy. I guess, how are you identifying these opportunities, or how do you plan on identifying these opportunities?
There used to be a pretty healthy secondary market for loans, and it's not been as robust. That said, I think more and more banks are realizing extended pretend is done, and they need to be able to come up with some kind of a marketplace. I've seen it openly marketed with some of the more nationally known brokers. But at the same time, if it's going to become a feeding frenzy, everybody's going to be looking at that. It's better to build on the relationships that you already have with existing lenders that are in the market. And when, for instance, a construction lender that we work with is in our office saying how we'd like to do more business, and just anecdotally, some of their strongest borrowers are still struggling with their construction financing on existing deals, that's when you raise your hand and say, what do you have on your books that you might want to unload? And treat it as a relationship play. The key there is the larger, more prevalent construction lenders, the Bank OZKs who we're working with on one of our projects, have so much activity that it's hard to find that diamond in the rough. Mm-hmm. If you identify the project, you look at the sponsor, you look at the lender, and you see it's a lender that doesn't have a tremendous amount of exposure and maybe it isn't their primary source of business. They're doing it from a relationship play on their outside. That's where you can step in and maybe be the savior to help restructure the debt in a way that You can still make money on it, but at the same time, if you need to take over, you get beneficial ownership. And that's where you deal with more of the international banks.
Interesting. Are there certain characteristics of these projects that you're finding are making them more like if you're looking at a project, for instance, is there a story behind geography or sponsorship or the type of project, if it's garden style or a high rise or like luxury versus more affordable? Just trying to get a better sense of the target, if there is something that is reoccurring.
Yeah, so affordable's out. I don't want to get into that space any longer. Workforce housing all day long, luxury, as long as it's not trying to be the top of the market, that sometimes struggles. That said, if it's built to a luxury standard and I can reconfigure it to a workforce housing deal and get it at the right basis, drop my rents and still be able to perform to my business plan and not the original business plan, that would be the sweet spot. Geography, all day long, you're still looking at where are the demand drivers. Okay, there might be oversupply in the market, but if everyone's building at a higher basis to what you're able to buy it for, then you're able to mitigate some of those factors that are causing people a lot of pain. It's easier to build garden style today, and one of our projects here in the Tampa region is proof of that, where we did a complete redesign and going from a wrap product with 2 phases to 14 buildings of garden style that are surface parked. The rents are going to be the same for the unit, but our basis goes from $400 a door to $300 a door.
Yeah.
Your return on cost goes through the roof. So that said, those garden style deals most likely have a more liquid exit because their basis is already lower for what they've been building. So the sweet spot is to actually buy that core plus wrap product, podium product, or even high rise that their basis is so high that the discount would be significant. And you're going to have a product that's more attractive to the renter in that market. So if you're reducing your basis, again, you can see where I'm going with that. It's just a math problem rolling downhill to what can I buy this for and what is the rent to where all of a sudden I'm making an outsized return.
Understood. And you had mentioned cutting your costs compared to other developers in certain markets. What strategies are you currently deploying to ensure that you're covering your tail if costs increase by 5 or 10 or 15% due to tariffs or any other outstanding circumstances?
So just like interest rates, tariffs have become kind of a boogeyman. They're in the media, they're being implemented, and nobody knows what the impact is yet. There's a lot of speculation. I will tell you, one of the issues that happened while I was away, one of our equity partners went pencils down on us right as we're about to close and break ground on a deal in Georgia. Within 5 days, we found a replacement equity partner. We're working on that JV. We're still on track to close. It's a little bit of a delay, but we're working through that process right now. But this person that we've worked with in the past that has faith in our ability to execute is willing to step up. And the tariff situation, when they looked at our underwriting, doesn't scare them. They feel that between our contingencies and the contractor that we're using, they understand that our way to mitigate the tariff right now is to sign our GMP and buy out the project. If I've got everything sitting here domestically in a warehouse ready to go, or I've already paid for it, or I have the commitments for it, that mitigates things more than waiting to see what happens and for those prices to increase. I'd rather buy the inventory now and almost treat it as a commodity than wait to see what happens. The issue that caused that person to go pencils down was they're a developer just like we are. It was a co-development deal. They wanted to put all the protections in the GMP on the GC. You absorb all these tariff costs. You've bid this project out, it's on you. What GC wants to do that? And the answer was, we can come up with a special like tariff contingency within the GMP. We're sharing the buyout savings. So if there's a certain amount of savings, there's shared risk. They want to get the best possible price and not pass it on to us because they're able to share in that before we have to hit our project contingency. So there's a lot of ways that we can align with our GC to get the best possible deal out of the situation. That partner, 2 weeks later, now that I'm back, just sent an email that's like, now that we've polled 7 different GCs on projects that they're looking at over the next 3 to 6 months, when it comes to tariffs, they're seeing anything from a 2 to 10% increase in cost based on what's going on. It's hard for me to understand where a 10% cost increase would come, because a lot of the, from a hard cost standpoint, you're talking about labor and materials, and labor's not being tariffed, the materials are. And of those materials, the bulk of those are still sourced domestically. Your lumber, your copper, your aluminum, your gypsum, your windows, okay? Certain things that need to be manufactured abroad and brought across the border, if they're already not here, should increase at a certain percentage. And granted, right now it's a 3-figure percentage with China, but certain things are on pause with Mexico, with Canada, and other places. So do I really think that we're going to see a 10% increase in my hard cost? No, I think that we're probably going to see 1 to 2 on a $50 million, hard cost situation. If my costs go up $500,000, I have a contingency in place that's well above that to be able to absorb that. I also have incentives for the general contractor to try to find something that's sourced domestically. So I think that being a little bit more aggressive right now works to my advantage and takes advantage of the fact that if I've got a long lead time on certain materials, if everybody else's pencils down, I'll buy it. I'm willing to take that risk, because as a developer, you take a certain amount of risk on yourself. As a GC, you took a certain amount of risk on yourself. I think if we're working hand in hand to try to mitigate that, it's a much better way to go than just being afraid of tariffs. Because again, the reason I want to be building right now instead of waiting, because of all the inventory that's being absorbed, my projects aren't going to actually start delivering until the end of 26 and early 27. There's not a lot of inventory coming online at the end of 26, 27, and into 28. So I feel that you're going to be able to absorb faster. So being aggressive right now, I think, works to your advantage instead of being pencils down. I don't mean to say just go crazy, but I've got 2 deals that we've been working on for the better part of 4 years that we've dialed in. We've got hard bids. We know what our basis is. We know what our rents are going to be. We know what the absorption levels are in the market. We still have a tremendous amount of conviction. Those deals were full speed ahead. Now, on future deals, as we're looking at land and underwriting for the next phase of our development pipeline, we're probably going to be a little bit more conservative.
Got it.
That really speaks to the price of land probably going down again.
When do you think the market will start seeing the price of land start going down again?
Now. And it really comes down to if you utilize even a 5% or a 7% increase to your overall hard costs on a go-forward basis because of everything that's happening. When you're building your pro forma and you're coming up to what the residual value of your land would be, it's less because rents aren't going up. We haven't seen the inflationary pressure that people are worried about as well, which also comes into play because then you are talking about the labor factor as well as the material factor. So if I've got everything going up from an inflation standpoint, hopefully rents are going up, at a pace that's similar to it. It's always going to have a lag effect. But I think that what you'll see is land basically compressing. Now, landowners that have been into it forever can wait it out and wait for things to come back. People that have land in their land bank or inventory that they were planning to develop are going to have that hard conversation of, okay, my basis might be 40 a door or 50 a door, but it's really worth 30 a door. What do I do? Can I still write it down, market to market, and make it up on the back end if I develop myself? Or is it time for me to exit? And that's really an individual's decision. It depends on their capital source.
So with these hard conversations being had, have you seen any unique structures come to be that historically you wouldn't have thought of enacting on, and whether or not you and your team are going forward with those structures. I'm more so curious to understand, how are people getting creative as it relates to the capital stack, as it relates to timing with these projects?
So debt's usually the first thing people talk about. I believe that there's plenty of debt available for a good quality development project. And especially because the detachment point's at 50 to 55% of cost. That lender has so much equity in front of it that there's not a lot of risk that they're taking on right now to make them say we don't want to be in the market for development or construction. The next piece where we've been levering it up using pref or mezz to about 70 to 75% of cost is still very prevalent, because a lot of the common equity players a few years ago said, why would I go chase a 14 or a 15% deal as common equity when I can put pref in place and get that same return? It's capped, but if that's what they're underwriting to and that's what we think the market is, why wouldn't we throw a $15 million slug out in pref? So I still think that element is still out there. The common equity is still where it's unique. People have talked about C-PACE financing as a way to deal with it and mitigate a certain amount of the cost of the construction loan and the pref piece. The stretch senior is becoming more popular when you get into those 9-figure check sizes. It's far more attractive to debt funds and groups that want to basically play on both sides of the aisle.
And Sam, for those who don't know what a stretch senior financing looks like, can you explain that?
Senior and mezz, or senior and pref put together with a single source, basically either group. It could be two sides of one house, a life co that has a debt fund and a life co that has the ability to put a mezz piece in, but it's serviced as one loan. So instead of having a loan to cost of 55% at SOFR plus 250 or 300, and a pref piece that's costing you 12 to 13% fully accrued, what they do is they say you got one loan that's basically SOFR plus 450, and you're sending it to them and they service it, and it's almost syndicated in-house, where they allocate a certain percentage of it to that higher percentage tranche and a lower percentage, lower risk tranche. So they handle that. It's almost like when you syndicate a construction loan between 4 or 5 lenders because of the size of the loan. Instead of doing it just on the construction piece, they do it with the construction and that next level of financing.
Perfect. Thanks.
So it's really the common piece that people are getting creative. Are you doing co-GP? Are you doing, co-GP with a limited partner? What's that limited partner look like? We're still finding greater success with high net worth individuals and foreign capital than we are with private equity for development right now. Although we are hearing that some private equity firms are starting to look at development again, which is nice. I think it's harder and harder to refute, looking at deals that have a 6.25 to a 6.75 return on cost that's actual underwriting and not stretched, versus things still trading in the market at sub 5 cap rates. So you do have 150 basis points of spread to be able to say this does make sense at this point. We want to be beneficial owners. We want to build a platform that's kind of more in that core plus range with maybe some value add attached to it, but with an opportunistic mindset towards the buy. They also, through controlling a lot of land in Austin, Denver, and Southern California, have about 7,000 units of development entitlement rights for multifamily. Let's say a regional mall, take out some of that parking lot, maybe build garden style today or wrap in the future. Same with Austin. Austin's overbuilt today, but by the time we get this entitled and are ready to start construction, that pipeline is going to dwindle, and they've got, again, kind of more of a main location in their other property types. So it's not quite a covered land play, but it's close to it, where they bought a regional mall for pennies on the dollar and it's underperforming. So turn the retail around, dress it up, make it look good, but also add some uses that are complementary and turn it into a mixed use project. So if we can build a few thousand units, buy a few thousand units. We start to build scale and raise capital around that and spin it away from the opportunity fund and create separate vehicles for multifamily on both the structured finance side as well as the ownership side. So really excited about that.
Are you going to ICSC?
Am I what?
Going to ICSC
Not this year.
in Vegas?
Yeah, I'm going to stick with like purely multifamily type stuff moving forward if I can.
Yeah, no, that's smart. This will be my first ICSC I'm going to, and I've been back and forth, but I think connect with as many people as we can. But NMHC 2.0.
NMHC is kind of a weird thing. Every property type has its core group of people that attend their conference. NMHC has it, ICSC has it, NAHB with the home builders have it, NIOP has it. I always think that the more you can be associated with those groups, the broader your network becomes, because at any given cycle, things are going to change. Office is going to be in vogue and then it's not. Industrial is going to be in vogue and then it's not. Multifamily's just been, coming into its own this last 10 years. Hotels, very, very sexy, and everybody thinks they're going to make a lot of money, and most people lose their ass. But at the same time, it's an interesting group of people to be around because let's face it, when you get to the home builders, they make a hell of a lot of money churning capital. They know how to churn capital better than anybody. And a hotelier, they're able to raise capital like you can't believe because of the sexy factor. It's the high net worth individual wants to say, hey, I own a part of the Fontainebleau, or I own a part of the W in Union Square, or whatever it is. So the ego factor comes into play, but also, draws a lot of people with capital. Sometimes it's well-heeled capital that knows how to make more money, and other times it's just an ego play and kind of dumb money. But either way, it's a good way to expand your network and kind of see where trends are.